This is the secret investment formula that hardly anybody talks about. It's probably the most powerful concept when it comes to investing, but people tend to gloss over it over get rich quick schemes or shortcuts. Guys, have you ever wanted to grow your money but you can't be bothered to analyze stocks, look at balance sheets and read company reports? Well, I was the same until somebody introduced me to the magical concept called compound interest. Now, I never really appreciated this until about a year ago when I really started to take investing more seriously. If you watch the entirety of the video, you'll understand this powerful concept where your money can make money for you and you don't have to continually analyze stocks and actually do a lot of work ongoing. If you're new to the channel, my name's Jag. I'm a software engineer in the financial services sector, and all that means is that I code for a living. This channel is purely designed to give you as much knowledge as possible when it comes to investing and personal finance. So if you're into that kind of stuff, then stick around, hit that subscribe button, but most importantly, hit the like button for the YouTube algorithm. Honestly, hitting the like button only takes a second, but it really helps out the channel and keeps me motivated to make more videos for you. Before we get into what compound interest is, we need to understand your current scenario. So let's dive straight in. Now, let's say if you're working and you're getting a set salary every month. Let's say for argument's sake it's $1,500. Keeping the maths simple. Then some spending happens and you set aside some money for rent, for going out, for cars. You're left with $500 in savings after all your costs. Let's do some quick maths. $500 a month saved is around $6,000 a year. Now let's say you're working at the same rate for 5 years and you're keeping the same amount of savings. Now that's $30,000 saved. Now this might seem like a decent amount, but while you're working, the world is moving around you and inflation has kept moving. Inflation, by simple definition, is when the cost of things around you increase. It's like when you bought a Freddo chocolate back in 2010 for 17p. Now it's 30p. It's not just Freddos, it's everything you buy. Milk, groceries, fuel, everything increases. But your $30,000 is still in your bank. Keep the math simple. Your $30,000 that you've kept in the bank across 5 years, keeping the math very simple, is going to be worth $27,000. You've just lost $3,000 of value. Now this is just 5 years. It grows even less when the time increases. How do we defeat this? How do we grow our money with us? This is where we introduce the concept of compound interest. Now bear with me. Let's say you invested $500 every month instead of saving it in your bank account. $500 at 10% interest rate per year. Let's do this for 5 years so we can sort of compare the smart money moves and the not so smart money moves. In 5 years, you open the pot and it's $39,000. 37 if you adjust for inflation. And that's a gain of $7,000. You would have lost that amount and it would have become $27,000. Now that's a $7,000 gain. Let me show you how this exactly works. Let's keep the maths very simple. Let's say you have $1,000. After a year, let's apply the 10% rule. Now you have $1,100. Because 10% of $1,000 is $100. But in year 2, you do the same calculation. Your money's now turned to $1,210. Why? Shouldn't we be going up by $100 a year? No. This is where compound interest comes in. You're getting the 10% of last year's amount and not 10% of $1,000 you started with. This is the magic of compounding. Now it gets very exciting when you do it for a long periods of time in a consistent format. Let's go back to this theory and apply the same maths with it. Putting away $500 at a 10% interest rate. Let's do a 10-year calculation. You do this for 10 years. Applying this principle for 10 years will get you $100,000. $92,000 if you account for inflation. And the magic is not the amount you deposited or invested. It's the amount that is generated for you. You deposited only $60,000, but you got $40,000 additional in value. The 11th year, you have 10% of $100,000, which will give you $10,000 passive income. You can keep going and going throughout time, and maybe your salary increases over time, so your savings will increase from maybe $500 to $1,000. Now 10% is a magic number. Where could we get this interest rate? We can't get it in a normal savings account because the banks won't give you anything at the moment, but I can get it in a very diversified fund called an index fund. An index is a collection of different companies which allows decrease in risk and allows you to take advantage of the increase of value in the stock market throughout time. I'll explain this concept further. If you invest in the S&P 500 index fund, which is a collection of 500 US stocks, it will give you an annualized return of 10%. Sometimes it will give you a return of minus 26%. But if you invest and hold long term, it will average out, and the average out will be 10% a year annualized. Let's say you started this in 2009. Compared to 2020, which is the year that just passed, this will give you an annualized return of 13%. Higher than the 10% number, but we're just going to keep to that 10% for now. If you did this in 2008, this will give you an annualized return of 9.63%. Closer to 10% number. Again, it's an annualized basis, on average. What exactly is this magical thing called the S&P 500? Well, it's a compiled fund of the best US stocks. It will give you weighted exposure to the best companies in America. What does it mean by weighted exposure? Well, since Apple is currently valued at $2 trillion, the company makes up 6% of the fund. So 6% of your $100, so $6, is going into Apple. Walt Disney, for example, is valued at $323 billion. So that is actually lower. So it only makes up 0.88% of the fund. So 88 cents of every $100 is going into Walt Disney. Now that's the magic. It's very diversified and it allows you to invest with minimal risk. The best part is that this fund is automatically monitored, like the Premier League of the stock market, in the sense that if one year a company does really bad and other companies are rising stars and they're coming up, well, that company is relegated and the other companies are promoted to the fund. Now, if you get the idea of how funds work, make sure you check out my video on the top 5 ETFs you can invest in 2021. Now, if you want to actually understand how do I get involved and how do I actually set up my account, then check out my video on setting up a Vanguard investing account right here. Now, I'm not promoting for Vanguard. You can get this fund on multiple platforms. You can get it on Trading 212, freetrade, HL, and others, to name a few. The S&P 500 is a standard that a lot of fund managers use to replicate the model across their specific holding. But why did I show you the setup through Vanguard? Because that's who I'm with. Because Vanguard has a very, very low fee structure, so it puts more money back in your pocket. Guys, if you enjoyed this video, then hit the like button, because that will give me the best return. And I'll see you in the next video. And check out my Instagram if you want to see more bonus content.